Well, we do see stretched valuations in a number of assets, including in some segments of equities. The recovery in financial markets is really remarkable this year. In the face of the COVID pandemic that has caused much economic damage, markets have recovered, and that has helped economies to sustain growth and to come back. But going forward, valuations could be fragile in the face of adverse news.
So it sounds like you're predicting that there is a real risk of some kind of market pullback or crash at this point.
There is a risk of a pullback, but having said that, if the economic recovery and the fight against the pandemic is successful, we might see further rallying in stock prices as well. So there's really quite a lot of variance going forward.
So against that backdrop, are negative interest rates such a good idea, given that they appear to have been responsible, alongside the fiscal stimulus, with just driving asset price inflation?
Well, central banks have intervened very aggressive and in a very timely manner into markets. G10 economies have expanded their central bank balance sheets by over $7.5 trillion since the start of the pandemic. That has helped ease financial conditions, and markets have come back. That helps economies to grow. So the ease of financial conditions is really supportive of economic activity, and that is an intended consequence of these central bank interventions. So these are asset purchases, low interest rates, and forward guidance about policy in the future.
But having said all of that, you still flag the risks here of some disconnect between asset prices and the underlying economies. So is it now the time for the central banks to actually step back and leave governments to take charge of the recovery?
For the moment, the accommodative monetary policy is appropriate around the world, as the economy is still in the depth of the crisis and hasn't fully recovered. However, once the recovery takes place, and we only expect that to be in late 2021 or even 2022, at that point, monetary policy has to be looked at and vulnerabilities have to be contained. Of course, monetary policy is not the only game in town. There's also prudential policy, and regulators around the world are looking and reevaluating the tools that they have in the prudential space.
Now, again, you flag up the risk in the corporate sector from indebtedness. Can I ask you, are you now predicting we will see a meaningful uptick in corporate debt defaults?
Well, in the corporate sector, a lot of support has been given via transfers and credit guarantees. And those are meant to be temporary support measures. And to the extent that the economy is going to recover to pre-crisis levels, those temporary support measures are fine. However, we have also seen an acceleration of structural shifts in the industry composition. For example, there's a big shift to online shopping away from retail shopping. And there's certainly a change in consumer behavior in other segments as well. So there might be some readjustment that is necessary. And the support measures should not stand in the way of the necessary adjustments. So we would see default rates go up in some segments, but that should not be, as we expect right now, be above levels of previous recessions.